Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah. And let's try and get the views of Trideep Bhattacharya, CIO of Equities at Edelweiss AMC, who joins us right now to tell us whether this risk on that we seem to be on, and it's very difficult to call something a trend these days, but let's still pose those questions to him, whether the risk on is sustainable, no, and more importantly, on the moves that have happened in select spaces of the last few days, and what does he make of those? Trideep, great having you. Thanks for joining in. Hope all is well.
Good morning. All is well. Thanks for inviting me to your show, man.
No, the pleasure is ours. Trideep, can I start with a bit of a micro? About 15, 20 days ago, and the jury was split about whether that's a right move or no, but the government levied windfall taxes on exports of fuel. And now that crude has come off a little bit, there has been a partial reversal of that as well. What does this make you feel about what the impact, if any, on these could be? And slightly longer term, does this make investing into some of these companies a bit unsustainable because of the policy flip-flop?
I think the second part of what you angled at is what is very relevant from us from a thought point standpoint, that when we analyze sectors, stocks that get impacted by regulation one way or another, one of the things that we look at in the framework that through which we analyze is to what extent can the regulation come and impact or take a share of the profits that the company generates over time, and that is usually reflected in the valuation multiple that the stocks or the sectors get depending on the regulation impact and whatnot. So I would say when events like these happen, it's a wake up call when, as we value these companies, that the valuation multiples need to kind of factor in the fact that the government, or for that matter the regulator, might come in and take some demand some share of the profits which may not flow to minority shareholders. So I think that's the investment implication, if you ask me, from a medium to long term standpoint. Coming to near term, I can see what the government is trying to do here, which is basically even out the supernormal profits that some of these companies are making, and ultimately, in some shape or form, kind of either pass it on to consumer or shore up your own resources, which can be used for multiple purposes. But what it does is, of course, kind of the realignment, the realignment of the profits ultimately impacts the minority shareholders of the stocks of the companies that they're invested in. And I think that is where it was negative when it came around, and now when it has been taken off, the stock has reacted. I think all in all, it kind of goes on to my earlier point that it when I look at, and when we look at these sectors or stocks, we build in the valuation multiples a certain room for volatility in earnings driven by the regulation.
Trideep, just one follow-up there. So if there is a belief that oil might be stronger for longer in the current decade because of the supply issues, and we all know that PSUs anyways get impacted quite significantly by policy moves, and that's the nature of the beast. This time around, a private entity too is out there. My question, therefore, is: do you reckon that the average multiples for both the PSUs and the privates, which may get impacted as a result of policy moves that could come in because of presumably a higher crude, would start reflecting into their multiples throughout? I mean, not just the PSU space, but even the private names?
If public sector names, for sure, I was going to say that if not already.
If not already, yeah, true.
So, at least when we look at the intrinsic values of particularly the public sector names and stuff like that, we build in a bit of policy uncertainty, a bit of government, the impact of government policy decisions impacting them in the valuation multiples that we deal with. Private sector would be a more secondary impact. But if that were to, I mean, so far, quite frankly, government has been more as an enabler and hasn't really kind of, too much of sanctions or too much of issues with the private sector. I hope it keeps that way. And that's why the valuation multiples have generally, for Indian companies, been on the higher side as opposed to some of our emerging market brothers. And I think as long as it remains that way, we are optimistic that the private sector is still reasonably investable. In other words, what I mean is, you sort of the output is a function of what the company puts in, rather than somebody else taking some share of the profits.
Sure. No, and to be fair, there is a very strong train of thought which says that some of the moves that have been taken are probably much necessary in an environment like this.
Exactly.
So, I mean, completely on ball with that. Just one final question on this before we move to the larger piece. Um, so, the question around other commodities also comes into place, that at a point of time when crude prices have come off and the windfall taxes have been taken off, could the same happen to some other pockets as well? Because the commodity complex by and large has come down. So can we anticipate some moves like these? And therefore, is there value there? Because the balance sheets of some of the metal companies are much more deleveraged than what they've always been. They've not been in reckless capacity expansion, and earnings might be okay.
So I think when you this is a far broader question than just the windfall tax, to take a view on the metal companies and whatnot. And I would say that if you look at the last 6-9 months of the volatility, the upward movement in the commodity prices, that has been at least partly driven by the supply chain shortages and various different measures that different governments have taken in the individual economies, like China economy being closed. We have put some tariffs on the imports and stuff like that. So I think, yeah, as we normalize, as China opens up, as our economy opens up, maybe the war situation kind of comes down a little bit over the next 12 to 15 months. I would say that as some of these pressures ease, commodity prices would actually settle lower. Whether they settle as lower as they now, or maybe slightly higher from here, is a matter of debate. But it certainly is unlikely to remain as elevated as we saw in the first 2 or 3 months of the year. Um, and I think that we draw comfort from, and that we feel is genuine positive from an asset class, from a equity market standpoint. And we are generally in our portfolios actually underweight metals. We have been underweight metals since better half, or in the beginning of this year. And our thinking has been precisely this, that the upward move in the commodity prices has been more driven by supply chain challenges rather than demand.
True.
And as over the next 12 to 15 months, these things normalize, the normalized levels of the metal prices or commodity prices would actually be lower than where we were. I think, quite frankly, given how the share prices have turned out to be, our stance has been proved on the right side. And given how volatile these markets are, the swings and roundabouts will happen. But on net, I would say that it ain't going back to those high levels.
Fair call. What about risk assets and equities at large, Trideep? There seems to be a bit of a risk-on mood today, but today notwithstanding, we are nearly 1,200 points higher from the recent lows. Is this a bit of a technical pullback, you reckon, or is there more to this move from the lows?
A move is a move, whichever way you call it, technical or fundamental. But let me put that in context. Actually, since the beginning of this year, we've held this view that the period from Jan 22 to March 23, this 15-month time frame, should be seen as a tale of two halves. The first
Mhm.
6 to 9 months of this year was always expected to be volatile, and the makings of this were fairly clear right up front. There is an interest rate regime change which is happening, the inflation, and finally the geopolitics. The good news, as we stand at as the final couple of months of this volatility, is that while on one hand it seems like 75 to 80% of the bad news is there or thereabouts in the price, on the fringes, you are seeing the commodity prices starting to come off. Whether you take a look at steel, copper, even some of the agri-based commodities have started to come off, which means that the lead indicator to the interest rate trouble or interest rate hikes that are happening in the United States and also in India, which was inflation, might actually peak and start coming down over the next 2 or 3 months. In other words, inflation might be ebbing overall from elevated levels that we are seeing, particularly in the United States and even in India. And hence, in that context, we think that what you are seeing, a bit of euphoria in the markets, is reflective of the same, or acknowledgement of the same. How long it lasts ultimately is subject to, in my opinion, the earnings upgrades or the earnings of the companies that will likely come through in this quarter, and more importantly, the outlook that they give for the next 6 to 9 months. So the sustainability is something that we are watching carefully. We think certainly in select pockets there is more room to go, whereas others might not, as we would think as an alpha manager. But overall, we think that there is some merit incrementally as commodity prices coming off is leading to a bit of cheer in the markets.
What's your base case, Trideep, for earnings for FY23?
So while we don't put out an exact number for the same,
broadly,
but my sense is, directionally speaking, the quarter that we are in, which is the June quarter, FY23, is basically the worst quarter that you would see from an India Inc. perspective. And the reason is that this is that quarter where probably you had the worst of the commodity price impact impacting the margins, and no positive impact from pricing that they might have taken over the last few months. From September quarter onwards, you will see some semblance of pricing power reflecting in the financials, while commodity pressures will start easing off. So gradually, kind of, the profitability situation easing a little bit. And hence I would say, and hence I made the comment that, this seems to be, from an earnings standpoint, in and around where the worst seem to be hitting the markets overall. I would say that this year growth might be somewhere around 16 or 17 odd percent, given where we are. If the commodities take a little more time to peak, maybe this for 16 or 17 comes down to about 14 or 15. I think the market is well digesting that. But overall, from a 3-year perspective, I do see that the India Inc. story is looking fairly robust. And the reason why it is looking robust is because for the first time, we might see a capex cycle come out, something that we haven't seen in the last 10 years. Second, the real estate sector is probably in the process of bottoming out. And third, for the first time, we are seeing in the Indian corporate sector salary hikes, which have been meaningful over the last year or so. So these impacting the important constituents of the Indian economy makes me feel that from a 2 to 3 year perspective, I think the earnings story is in reasonable shape in India, bottom up. The macro looks a little debatable, though.
Yeah, so you on earnings, you're sounding like that muscular Spanish bull. Now, let me ask you, Trideep, if you juxtapose this with the macro and the ideal valuations that you would want to pay such a macro, are we richly valued? Are we okay? Or are we available at a slight bargain?
I would say I was okay on average, bargain in some pockets, expensive in others. In other words, what I'm saying is, since the beginning of this year, the valuation or Indian market, so to speak, has derated by almost about 20-25%. While earnings cut has not been that big, which is a good part, driven by global macro and all the things that we discussed upfront. I think the valuation multiple has corrected almost about 20-25%, which makes me feel that we are reasonable. Are we at one standard deviation down? No. But then there are some parts or some pockets where we think, there is still good earnings upgrade story coming about, and valuations are kind of attractive to reasonable and worth making it work for investors.
And you reckon that the sentiment could be okay despite the macros looking challenging?
I think the sentiment at the moment in the very near term is actually bad, if you ask me.
Yeah.
So if you look at whether you look at any newspaper, news channel, or wherever you see, you hear recession, you hear interest rate hikes, you hear inflation, you also hear some of the economies kind of going through real tough shape, some of the emerging markets along with the currencies. So this is as good a negative news or as bad a negative news that you can think about. But remember that, the saying goes in investing that, invest when there is a famine and reap when there is a feast outside. So at the moment, it looks like a famine type situation with ton of negative news in and around. And hence we think that this might not be that bad a time to look at some stocks overall.
Interesting. The BOFA, I viewed the BOFA fund manager survey done yesterday. A global fund manager survey also points to almost a replica of what Trideep just mentioned right now. And they expect some rallies ahead. So Trideep, where is it that you're finding a favor? I heard you say that in some pockets we might, if not a bargain, then at a good valuation. And I presume that you're marrying the valuation with the return potential as well, because not everything which is cheaply valued might give returns. So where is it that you find these pockets of possible outperformance?
So I think basically it's more ultimately married to the three themes that we talked about, which we are bullish on from an Indian market standpoint, from a medium standpoint. See, one has to, Neeraj, I'm sure you will appreciate the portfolio construction can't change every month. It is usually done with a 3 year in mind, and then we kind of toggle around depending on the changes midway. So the areas that we are bullish on and we are overweight in our portfolios are industrial stroke capital goods. I think certain components, particularly in and around indigenization of defense programs, etc., are looking quite reasonably valued versus what the potential might turn out to be, which is a part of industrial stroke capital goods and industrial capital goods in general. This kind of follows on from the earlier point that I made, that if we do have a private sector capex cycle coming through in the next 2 to 3 years, these guys would benefit significantly. Second, we are positive on indirect plays on real estate as well as direct plays. We think that if the sector is bottoming out, as long as we don't overdo on the rate side over the next 3-4 years, we are still have a good run in front of us for the sector. More indirect plays than direct, because there we see better quality companies coming through. And finally, basically, select consumer stocks with pricing power is something that we are positive on. This segment had corrected meaningfully in the valuation derating that has come about, and I would say valuations are still not dirt cheap, but some of them versus their history are still looking reasonable. So we are selectively overweight there. And finally, some of these government scheme beneficiaries like PLI, etc., will make a difference over a period of time. So those are some areas that we are kind of positive on in our portfolios.
One final question, Trideep, can't let you go without talking about the space on which everybody split right down the middle. IT, Nasdaq is showing some bit of activity there, but what's your sense on IT?
I think basically IT was sitting on a bit of supernormal earnings, if I may say so, in the last 2 years, because we are all locked down and the focus on digitization was on top of our head. And that supernormal earnings was amplified by higher valuations. And some of the particularly mid-cap IT names, new age companies being the extreme, saw valuations which were really similar to B2C companies, even though it is a B2B company. I think a lot of water has flown under the bridge since the beginning of this year. And I would say that broadly speaking, the valuation correction that had to happen, valuation multiple correction, is behind us. What remains is that we have adequately captured the slowdown in United States, which is something which is an imponderable but lies in front of us over the next 6, 9, 12, 15 months, adequately in the earnings forecast. There, I think as we head the September quarter, not immediately, had we head the September quarter, we'll probably kind of get to understand whether the earnings have bottomed out or not. So that bit of adjustment remaining to be done, but we're probably not far away from there, I would say. So we've actually went underweight IT right about September, October last year. We are now contemplating as to, we're now in a contemplative mode, let me put it this way. And maybe in the next 2 or 3 months, we'll evaluate which direction we want to head.
Okay. Well, lovely talking to you, Trideep. Thank you so much for the insights, and all the best with the contemplation, if you will, and look forward to talking to you soon.
Absolutely. Thanks for inviting me on your show, Neeraj. As always, very intelligent questions.
Yep. Cheers. Thank you so much. Lovely having you, viewers. Thanks for tuning in.
Bye-bye.